We are in the midst of earnings season once again, but it's been another thing grabbing headlines recently, and that is the recent wave of job layoffs that we've seen, specifically in the tech sector, with Google's parent company Alphabet being the latest one. So in today's video, we're going to be looking at their recent announcement, how the share has been performing, and what that means for their upcoming earnings. Hello and welcome back to our channel. My name is Daniela Hathorn, and as I said in today's video, we are going to be looking at Google's parent company Alphabet. What have they been doing recently? What does these job layoffs that they've announced mean for the company? Was the market expecting them? How did we see the share price react? And of course, what can we expect from their earnings next week? So please like this video, comment, subscribe, and turn on your notifications. Okay, so the key headline is that Google's parent company Alphabet has announced 12,000 jobs to be let go, employees to be let go. And this comes on the back of a recent wave of employee layoffs that we've seen. Just last week, we saw Amazon laying off about 18,000 employees and Microsoft another 10,000. We saw it from Meta as well at the end of last year. So it's something that's been going on. Now, one of the reasons that Alphabet has cited was the company has been facing increasing challenges, of course, not isolated to them, just in general in the industry and in the economy. We've seen higher interest rates, of course, soaring inflation, all of that putting pressure on the jobs market. So overall, a gloomy macro environment, which means that the wave of hiring that we saw throughout 2020, 2021, and also last year as well. They hoped for a different economic reality. They hired for that reality to be different than where we are now. So that meant that this shift in the economic outlook has resulted in around 12,000 employees being let go in the next few months. Now, they did say they want to focus a lot on AI, and that is one of the key areas that Alphabet is now venturing into. But there is a lot of competition there. Now, we know that we've seen Microsoft investing in or increasing their stake in ChatGPT. We know that's been one of the very in demand and popular AI sources in the last few months. It's one of these chats that you pose a question and AI comes up with a prepared answer for you. There's been a lot of interest in it, and we know that Microsoft is becoming one of the big investors in it and therefore posing big competition for Microsoft. So of course, further a challenging environment ahead, but nonetheless meaning that their focus has shifted slightly. Now, let's take a look at the actual announcement of the layoffs. Was it unexpected? No, not really. As I said, we've seen a host of tech companies doing the same thing, starting with Meta last year, and just this previous week, just before Alphabet announced it, we saw also from Microsoft and Amazon. So no, it wasn't unexpected. And also in 2022, we saw their profits shrink. We saw their share price almost half, and their workforce continue to increase. So at some point, investors knew this was going to happen. In fact, if we see the reaction in the stock market, on Friday, we saw the stock up about 5% at the open. That seems to be a little bit of a relief trade from investors. They were expecting this to happen. They want the company to be more competitive in the long run. And it seems like this is one of the steps in the right direction for that to happen. So overall, the layoffs have been seen as a good sign from the market. Usually when we see a lot of companies laying off employees, it's a sign of turbulent times ahead. It's not really the case right now. We're already expecting this. We knew that the high interest rates from the Federal Reserve and central banks across the world and soaring inflation was going to pose a difficult and challenging economic environment in 2023. So companies laying off employees really isn't taken as a negative sign. In fact, it's, as I said, a little bit of a relief as companies kind of try to shape their way through this turbulent time, hoping for a brighter future once we're on the other side of it. So As I said, the stock market seems to perform quite well, and we're now looking at their earnings. They are going to be reporting their fourth quarter earnings next week on February 2nd, which is Thursday. And a lot of focus is going to be on their advertising industry, because we know advertising spending has shrunk a little bit as well. Companies seeing their margins reduce, seeing customers spending less, which means their profits have been reduced. So expect to see their advertising profits shrink a little bit in the fourth quarter. So I expect a lot of focus around that. And of course, investors are going to want to probe about their layoffs in the earnings call from top management, despite already having been justified in their announcement last week. So that is generally the feeling we have with Alphabet at the moment. It seems like the right decision on behalf of investors. At least that is their view in the market. It's just a case of how do we grow from here, and how do they become more competitive in the AI industry if that's the way they want to go. So let's pop onto the chart now to see how the share is performing and what we can expect from it in the next few days. Okay, so here we have it, the Alphabet chart on the TradingView platform. As you can see, the share is currently on the pre-market. We still have about 3 hours to go until the main market opens. But as you can see on Friday, that really strong push there on the back of those layoffs. Prior to that, we'd been consolidating just around that 90-91 area for the past week. We didn't manage to see a lot of momentum. You can see also volume slightly depleted there. Picking up on Thursday, but definitely on Friday, really seeing that rush of interest there for Google's parent, Alphabet. Now, if we zoom out a little bit to see the last time we were around these areas, we can see back here in March 2021, we actually saw a little bit of consolidation here before managing to break higher. And that was also the area that we saw back here in December as a key area of resistance, and really bringing on that further downward trend, almost attempting to break the 2022 lows that we saw in November. So let's just mark this here with the horizontal line, because this could be an interesting area of resistance up ahead. As you can see, that high here from December 1st, really bang on the middle there of that consolidation area back here in February and March in 2021. From there, we saw a rapid rally and then a clear bullish pattern. As you can see, those higher highs and higher lows building up towards that 140 area. Now, as I said, we do have a few obstacles up ahead. One of them being the earnings out next week. We can either see some good downward momentum or upward momentum from that. Earnings are usually a really good time to provide volatility to the market, also pre-earnings as well. So watch out for that. For now in the pre-market, it seems like we are likely going to try to build up from those moves on Friday. As I said, watch out for resistance just around the 102 area. I wouldn't be surprised if we see a little bit of a sideways consolidation from that as well. And also potentially a little bit of a pullback as markets digest the recent the recent announcement on the jobs market. But also on Wednesday next week, so the day before earnings, we'll have the Federal Reserve announcing their February rate decision. That could also expect to see increased volatility around that as well. So be aware if you do have a position open on Google heading into the earnings season. Watch out for some volatility heading into next week as we kind of culminate into that Fed meeting that everyone has been so expectant of. And we're now expecting 25 basis points to be hiked at that meeting. Let's quickly look at the price to earnings ratio for Google, because it's actually pretty low, as you can see, just around that 18 mark. This is a little bit higher than where we were back in December. But if we zoom out a little bit, it is an area where it's pretty undervalued. The share price looks to be undervalued based on this ratio. As you can see, the last time we were roughly around these areas, and even not as low, was back here in March 2020. Of course, we had the pandemic effects there as well, but also here in January 2019. And from those times, every time we've been around this area, anywhere below 24.20, around that area, we've seen a little bit of a push higher, even back here from the pandemic lows around 21 price to earnings ratio. We saw that subsequent rally, and it looks like that PE ratio has started to build a little bit to the upside as well, signaling potentially that change into momentum, especially that bearish move that we've seen from these highs in 2022. So it looks to me like the path of least resistance could be turning to the upside. As I said, watch out for that resistance there just around 102. We may see some sideways consolidation around this area, and also watch out for that Fed meeting on Wednesday prior to Alphabet's earnings announcement on Thursday, the 2nd of February. That is it for today's analysis on Google's parent company, Alphabet. Thank you for watching, and don't forget to subscribe to our channel.